Accounting policy and the disclosure thereof is one of the parts of accounting which is simple, yet very important and forms part of some of the fundamental principles that determine how the accounting process works. So accounting policy is the set of decisions that determine how the enterprise will treat the same type of transaction to achieve consistency. This must be disclosed in the financial statements. For example, if the enterprise must disclose on which basis it deals with the depreciation of property and equipment. Generally accepted accounting practice is a foundation that acts as a general framework to encompass accounting concepts, principles, methods, and procedures. And according to GAAP, the two main underlying assumptions with regards to financial statements are the accrual basis and the going concern. There are four main qualitative characteristics, which say that the financial results must be understandable to the users thereof, they must be relevant, they must be reliable in their consistency, and they must be comparable, for example, with the previous financial periods. Financial statements include two elements, namely the financial position, which deals with the assets, liabilities, and equity of an enterprise, and the financial result, which deals with the income and expenditures. These are also called nominal accounts. Let's quickly have a look at the financial position. The financial position is shown on the balance sheet, and this depicts the assets and interests of an entity at a given time. This leads us to what is called the basic accounting equation, which says that assets are equal to the interest of an enterprise. Interest being equity, which is the owner's financial interest, plus liabilities, which are the creditor's financial interest. This says that assets are equal to equity plus liabilities. Or differently stated, equity is equal to assets minus liability. Now, equity is the accounting term used to show the financial value of an enterprise, or which is referred to as the net worth of a company. The enterprise's net worth is therefore equal to the assets minus its liabilities. Whereas the financial position shows us the net worth of a company at a given time, the financial result shows us the profits and losses incurred by the enterprise over a specific period. This is shown on the income statement, and it says that the financial result is equal to the income minus the expenditures, or the net profits and losses. We can use this information to elaborate on the basic accounting equation, which basically states that incomes and expenditures affect the equity of the business, and thus the basic accounting equation in its entirety is that assets are equal to equity, which is capital, plus income minus expenditures, plus liabilities.